According to Vanguard's 2025 How America Saves report, more than half of all 401k participants who have access to a Roth option inside their plan have never made a single Roth contribution. More than half. With access to the account, the option sitting right there in the same plan, offered by the same employer, available without opening a separate account or meeting an income threshold. They have simply never used it. And the reason is not that they thought about it and decided traditional was better. The reason, in survey after survey, is that they never ran the comparison at all. They selected a contribution percentage on day one, accepted whatever default their employer chose between pre-tax and Roth, and have been contributing to the same election ever since in some cases, for a decade or more, without revisiting it. Here is what that single unchecked checkbox may be costing them. For a 33-year-old earning $85,000 per year, contributing the same amount to the same 401k for 30 years, the difference between choosing traditional and choosing Roth, applied to the full contribution and compounded at market average returns, can change the after-tax value of the retirement account by over $200,000. Not the balance, the after-tax value. The money actually available to spend. And for some people, traditional is the correct choice. The math genuinely favors it. But that math has to be run. And most people have never run it. Today, we are going to run it. In full. With real 2026 numbers, real tax brackets, and the 4 variables that flip the answer in ways most people have no idea exist. Here is how most people describe this choice to themselves. Traditional 401k. You put money in before taxes. Your paycheck feels less reduced. The contribution grows tax-deferred. When you withdraw in retirement, you pay income tax on everything you take out, the contributions and the growth. Roth 401k, you put money in after taxes. Your paycheck feels a little more reduced. The contribution grows completely tax-free. When you withdraw in retirement, you pay zero, not on the contributions, not on the growth, not on any of it. Stop here for a moment, because that simplified version of the decision leaves out the variables that actually swing the math the most. Your tax rate at withdrawal is not the only variable. It is not even the most important one for many people. There are 4 variables that most people have never seen applied to this decision, and each of them is capable of changing the answer completely. But first, let's establish the baseline. What does the math look like when the only difference is tax timing and everything else is identical? Let's use a specific scenario. Age 33. Annual income $85,000 in the 22% federal marginal tax bracket. Contributing $1,000 per month to a 401k. 8% average annual return. 30 years. If that $1,000 goes into a traditional 401k, it goes in pre-tax, meaning the ears has not touched it yet. The full $1,000 compounds for 30 years. At 8% annually, $1,000 per month over 30 years grows to approximately $490,000. If that $1,000 goes into a Roth 401k, it goes in after tax, meaning $1,000 of after-tax dollars represent $1,282 in pre-tax income at a 22% marginal rate. Fewer pre-tax dollars are going to work. The actual after-tax dollars that compound are $1,000 per month, the same number, but they are worth less in pre-tax terms. Same balance at the end, approximately $1,490,000. But this time, it is entirely tax-free. Now here's the key number. At retirement, The traditional 401k owner withdraws $100,000 per year. If their effective tax rate in retirement is 18% lower than their working 22%, they pay $18,000 in tax on $100,000 withdrawn. They keep $82,000. The Roth 401k owner withdraws $100,000 per year. They pay nothing. They keep $100,000. The difference in spendable income, $18,000 per year. On a 25-year retirement, that is $450, in additional spendable wealth from the Roth, before accounting for what those annual tax savings could have been invested in. But wait. The traditional 401k owner paid less tax during accumulation. They saved at the 22% marginal rate on contributions. Doesn't that offset the retirement tax? Here is the answer. If the tax rate at contribution and the effective tax rate at withdrawal are identical, the accounts are mathematically equivalent. The IRS gets the same slice, it just takes it at a different time. The Roth wins when your effective retirement rate is higher than your current marginal contribution rate. The traditional wins when your effective retirement rate is lower. The question is not which account is bigger. It is which one leaves more in your pocket after the tax bill is settled. Variable 1. The employer match structure. Most people know their employer matches contributions. What many people do not know is where that match lands, regardless of which election you make. If you contribute to a Roth 401k, your employer match in almost every plan goes into the traditional pre-tax side of your account. The employer contribution is always pre-tax, regardless of whether you chose Roth for your personal contribution. This means that even a committed Roth contributor will have a traditional balance at retirement from the employer match, and those dollars will be taxed as ordinary income when withdrawn. This has two implications. First, it means nearly every 401k participant will have a mix of traditional and Roth dollars at retirement, even if they selected only Roth during their working years. Second, it means the choice is not purely between one account type or the other. It is about which type your personal contributions go into, with the understanding that a parallel traditional balance is accumulating on the employer's side. For tax planning purposes, this is actually useful. The traditional employer match can be drawn down first in early retirement years, filling lower tax brackets at the 10 and 12% rate, while Roth dollars are preserved for years when income is higher, or when heirs inherit the account tax-free. Variable 2. Required minimum distributions. Traditional 401k accounts require withdrawals beginning at age 73 under the current rules established by Secure 2.0. The IRS requires you to take out a minimum amount each year, calculated based on your account balance and life expectancy tables, whether you need the money or not. These withdrawals are taxed as ordinary income. Roth 401k accounts, unlike Roth IRAs, did previously require RMDs during the owner's lifetime. Secure 2.0, effective beginning in 2024, eliminated RMDs for Roth 401k accounts as well. This is one of the most significant recent changes to retirement account rules. Starting now, a Roth 401k can grow and compound for your entire life and pass to heirs tax-free, without the government forcing a withdrawal at any age. Let that land for a second. The government will force withdrawals from your traditional 401k at age 73, generating a taxable event every year whether you want one or not, potentially pushing you into a higher bracket, potentially making more of your Social Security benefits taxable, and eliminating the option of letting that money compound further. The Roth 401k after Secure 2.0 has no such requirement. For people who do not need to draw heavily from retirement accounts in their 70s because they have other income, this difference alone can represent hundreds of thousands of dollars in after-tax wealth over the course of a long retirement. Variable 3, Social Security interaction. This is the variable that surprises people most, and it is one of the most significant tax interactions in all of retirement planning. Traditional 401k withdrawals count as ordinary income for the purpose of the provisional income calculation that determines how much of your Social Security benefit is taxable. If your provisional income exceeds $25,000 as a single filer or $32,000 as a married couple filing jointly, up to 50% of your Social Security benefits become taxable. If it exceeds $34,000 single or $44,000 married, up to 85% of your Social Security benefits become taxable. Roth 401k withdrawals do not count as provisional income. They are not in the calculation at all. A retiree drawing primarily from Roth accounts can receive their full Social Security benefit without triggering the tax on that benefit, even if the Social Security check is substantial. The practical consequence is significant. A retiree with $40,000 per year in traditional 401k withdrawals and $30,000 in Social Security may find that $25,500 of that Social Security benefit becomes taxable. At a 22% rate, that is an additional $5,610 in tax per year, on top of the tax owed on the withdrawal itself from Social Security benefits that they believed were mostly protected. This is a shadow tax on the traditional 401k that does not appear in the simple pre-tax versus after-tax comparison. It appears only when you run the complete retirement income model. Here is the framework the financial planning literature consistently supports. Step 1. Contribute enough to capture the full employer match. Your employer match is a 50 to 100% instant return on every matched dollar before any market growth. No Roth tax advantage can beat free money. If your employer matches 4% and you contribute only 3%, you are leaving compensation on the table, and that match will go into the traditional pre-tax side regardless. Capture the full match first. Always. This is not a tax strategy question. It is a compensation question. Step 2. Evaluate your current marginal rate against your expected retirement effective rate. If you are currently in the 22 or 24% bracket and expect to withdraw primarily in the 10 and 12% brackets in retirement, because your spending will drop. Because you will have the flexibility to draw slowly. Because Social Security replaces a meaningful portion of your income needs then. Traditional contributions save you more now than the Roth would cost you later. The traditional advantage is real in this scenario. If you are early in your career, currently in the 10 or 12% bracket with decades of income growth ahead, or if you believe federal tax rates will increase materially over a 30-year horizon, the Roth wins. You are locking in today's rate on a compounding base that will be worth vastly more by retirement. If you genuinely cannot predict which rate will be higher, which is an honest answer for many people in their 30s and 40s, splitting contributions between traditional and Roth hedges the uncertainty. You build both a taxable and a tax-free bucket. In retirement, you pull from whichever bucket is taxed at a lower rate in any given year. This is tax location strategy, and it is one of the most valuable tools in retirement planning. Step 3. Apply the variables to your specific situation if you expect significant Social Security income and do not want 85% of it taxed in retirement. Roth contributions reduce the traditional balance that would push you over the provisional income thresholds. If you want the flexibility to let your retirement account compound past age 73 without forced withdrawals either, because you have other income, or because you want to build a tax-free inheritance for heirs, the Roth 401k, under Post-Secure 2.0 rules, is the superior vehicle. If you are over 50, earning above $145,000, and subject to the mandatory Roth Catch-Up, the heirs has already partially answered the question for you. Here is the single most important piece of math in this entire comparison, and the one that most people have genuinely never seen applied to their situation. When you contribute to a traditional 401k, you save tax at your marginal rate, the rate on the last dollar of your income. If you are in the 22% bracket, every dollar you defer saves you 22 cents in current taxes. But in retirement, traditional withdrawals do not all land in your current marginal bracket. They fill your tax brackets from the bottom up. The first $16,550 of income for a single filer in 2026 is taxed at 10%. The next $32,150 is taxed at 12%. The next $70,950 is taxed at 22%. The effective rate, the average across all of those tiers, is significantly lower than the marginal rate. A retiree withdrawing $80,000 per year does not pay 22% on all $80,000. They pay 10% on the first tier, 12% on the second, and 22% on the portion above that threshold, producing an effective rate of roughly 14 to 15% on the full $80,000. This creates a specific scenario where traditional 401k contributions genuinely win the math. If your current marginal rate is 24% and your effective retirement rate will be 15%, you are saving at 24 cents per dollar today and paying back 15 cents per dollar in retirement. That is a 9-cent advantage on every dollar compounded over 30 years of contributions. Conversely, the Roth wins when your current rate and your effective retirement rate are close to equal, or when retirement income from multiple sources, security, pensions, required minimum distributions, investment income pushes your effective rate higher than it appears at first glance. The Roth also wins in a way the bracket math does not capture. Every Roth dollar is a dollar that will never require a tax filing, never trigger a provisional income calculation, never generate a required minimum distribution, and never impose a tax on your heirs when it passes to the next generation. This is not a debate about which account is better. It is arithmetic, applied to your specific marginal rate, your projected effective retirement rate, and the 4 variables the match structure, the RMD rules, the Social Security interaction, and the Secure 2.0 catch-up mandate that most people have never included in the calculation. The 2026 numbers you need: 401k contribution limit is $24,500. If you are 50 or older, the catch-up is $8,000, making the limit $32,500, and if you earn above $145,000, that catch-up must go into Roth. For 60 to 63-year-olds, the enhanced catch-up of $11,250 applies, for a total of $35,750. IRA contribution limits are $7,500 this year, $8,600 if you are over 50. Here is the question worth sitting with tonight. Not which account is better in general, your specific question. If your effective tax rate and retirement accounting for Social Security, accounting for what you will actually withdraw per year, accounting for any pension or other income is likely to be meaningfully lower than your current marginal rate, the traditional contribution is doing real work for you right now. If those rates are close, or if you cannot predict the answer with confidence, Splitting between traditional and Roth is the rational hedge. Your action from this video: open your last pay stub. Find your federal withholding rate. Estimate your expected annual withdrawal in retirement, what you actually plan to spend. Compare those two rates. If you have never done that calculation, that is the calculation your 401k election has been waiting for. Drop a comment below. Are you currently contributing traditional Roth or splitting? I want to see where this community actually sits before the next video in this series. Subscribe for a new personal finance video every week. See you in the next one.